Good morning, good afternoon, and good evening from whichever location you are watching me from. My name is Prince Dunzo Onwodi or Dunzo Laurel Accountancy Tutorial. Today we shall be going through flexible budgeting in management accounting, sometimes called flex budget. Budgeting itself is a plan in financial terms of what an organization intends to achieve in a defined period into the future. Once done, actual performances must be compared with budget to ascertain deviation for control purposes. However, actual unit level of volume achieved are not always the same as budgeted level, as like must be compared with like for a meaningful comparison. Flex financial figures for the actual level achieved must be computed for comparison with the actual financial figures of the actual level achieved. Example is necessary or will be needed to explain this particular topic. Here is an example. A monthly operating statement is shown below with some explanatory notes. Those notes are crucial. We need to scrutinize them. There will be some cost structure elements here. Some will be fixed, some will be semi-variable, some will be stepped. Okay, so look at that the additional information to help you with this exercise. Now, you are required to flex the budget, calculate variances, and show whether each variance is favorable or adverse. We have different columns here. The first column shows the item itself, the unit, revenue, cost. For instance, we have material cost, labor cost, distribution, and so on. The second column is the budget figure itself, or the units planned for was 36,000. The revenue expected 396,000. The material cost 99,000. Labor cost 54,000, and so on. Go through the list. The third column there is the actual performance. All right. You can see that the level achieved was quite below the expected level, 33,000 compared to expected 36,000. That's the reason for this exercise. We cannot compare 33,000 actual level with the 36,000 expected level. We need to flex this 33,000 actual level and compare the flex budget for this level with the actual performance for this level. Okay, this is what we need to do. Now, look at the additional note in the next slide. It will help you to complete this exercise. Here are the notes. First one, material, labor, and distribution costs are variable. So we need to establish the variable cost per each item. The second note there is the budget for energy is semi-variable. The variable element is 90p per unit. With this, we need to derive what the fixed element is. The third note is the budget for equipment hire is stepped, increasing at every 5,000 units of monthly production. Again, we have to find out the cost increase by each step. Depreciation, marketing, and administration costs are fixed. Very simple. We just need at this point to extract the fixed costs for each item and put them straight to the flex budget, because fixed costs will never change irrespective of the level of activity. Now, I will let you do this, okay, on your own, and I will get back to you to see if we need more support. Good luck. Here is the solution to this exercise. Okay. As you can see, I've added more columns for explanatory purposes. The second column here, I have shown revenue to be A and total cost to be B. So the profit P equals A minus B. That's the bottom line here. You see. Okay. I've added another column, fourth and fifth column. The fourth column shows notes. This note will point to where I explain the note to the example. Okay. Note 1 is to do with the fixed variable cost element or semi-variable cost. Okay. Then the other one, note 2, is to do with the step cost, and note 3 is merely the fixed cost element. Right. You have now, the first thing to do is to derive the variable cost per each item. The revenue of 396,000 will give us £11 per unit when you divide the 396,000 by 36,000 units. That's how we got the £11 per unit. For the material costs, we need to divide the 99,000 by 36,000 level. That's how we got the 2.75 pound. The labor costs, which is 54,000, is divided by 36,000 again to give us 1.5 pound per unit. That's how we derive the variable cost per unit. Okay. Once this is arrived, we now have to flex the 33,000 units. So the revenue will be £11 times 33,000. That's how we got the 363,000. For the material cost, it will now be 33,000 times 2.7 pounds per unit. That's how we got the 90,750. The next one, labor, is 33,000 times 1.5, which gives us 49,500. That's how we derive all the flex budget for the actual level of performance. In note 1, we explain how we got the 34,700. In note 2, we let us know how we got the 440 for the flex budget in the next slide. And the note 3 is simply telling us that the fixed cost will be the same for the flex budget as well, as they will not change. Having done that, it is now the flex budget of the actual level, 33,000, we need to compare with the actual performance at that level of 33,000. Looking at the first line, the revenue, you will notice that the actual performance was better than the flex budget. That's how we got the favorable variance of 8,250. So we say 371,250 less 363,000 to arrive at 8,250 favorable. Now, pick on the cost side. Let's look at the material cost. If you notice, if you watch carefully, you notice that the flex budget is actually higher than the actual performance. So if you deduct 89,900 from 90,750, we have a favorable variance of 850. So we will now do the same thing for the other costs. We deduct 50,750 from 49,500. You see that it's negative because we have now deducted a higher figure from a lower figure. So it's an adverse labor variance. Deducting 1,550 from 1,650, you notice that it's favorable because we're now deducting a lesser figure from a higher figure. So that's how we have to go through the whole row one by one and arrive at the variances, which give us a net positive variance of 6,454 for the for profit under the variance column. Okay, every positive item is favorable and every negative item is adverse. That's how you know whether they are favorable or adverse. Look at this. I hope you understand the system of computing the variances from the flex budget. Now let's look at the note. As I said here, the note 1, which talked about the energy cost, we first of all find the equation that fixed cost is equals to total cost less total variable cost. So for energy cost from budget, variable cost per unit is 90p. The total budgeted cost is 37,400. The total budgeted variable cost is 32,400, that is 36,000 times 90p. Then the fixed cost will be total budgeted cost of 37,400 less total variable cost 32,400 to give us a fixed cost of 5,000. That's how we got a fixed cost of 5,000. So when we come to the flex budget, what we need to do is to multiply the activity 33,000 times 90 to give us 29,700. Then add the fixed cost element to it to arrive at 34,700. That's how we got that 34,700 in our flex budget for energy. For equipment hire, again, we need to see how many 5,000 we have in the budgeted level of activity. So 36,000 divided by 5,000 give us 7.2 times. Now, as the cost is 480, it means that each change will be charged with 66.67 pounds. That is 480 divided by 7.2 equals 66.7 pounds for each step. Looking at the actual volume, which is 33,000, we will have 6.6 steps of 5,000. Right. So it is this 6.6 step times the cost per each step, 36.67. That's how we got the 440 for the energy equipment hire. For the F, note 3, the fixed cost, as I explained earlier, is just a question of taking the figure and putting them straight to the flex budget, as they will not change irrespective of the level of activity. I hope you are happy with this. Go through them again. Practice makes perfect. If you have enjoyed this tutorial, as I've just gone through with you, please give us a like and do subscribe. It's by subscribing you encourage us to prepare more materials, tutorials like this for your consumption. Thanks for watching. I will see you some other time.